This is Retire Hour.
Welcome into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And, you know, there's a lot of changes coming out of Washington, seems like every day, but you need to stay up to date on this stuff because most of the time we find people find out they've missed something or they've made that large mistake that's cost them either thousands of dollars, either in missed opportunity, investments, maybe fees, or maybe even the taxes. And if you don't have someone that's helping you navigate retirement, you know, we're a complete retirement team here. My name is Matt Goolsby. I'm your host. We're a financial advisory group, but we also have the tax advice, the estate planning help, and the help with your healthcare, Medicare. That's so critical to navigate those changing issues in retirement. We've got a full show for you this week. Later, coming up after the break, we'll have Corey Hebert talking about drawing Social Security and what impact that has on Medicare in relations to your premiums and how you pay them. Coming up with Doug Schauter. He's one of our estate planning attorneys down from Kansas City to record some TV this week. Doug will be talking about make sure you have all your beneficiaries up to date and a horror story that goes along with that on someone that didn't. Then finally, rounding out the tax segment, we'll be talking with Susan from Market Tax Services about how she's working with a client who wondered if they should start their Social Security and what tax implications that had there. Of course, we've got the advisor half of the show in the first half, but you know, I want to talk to you about someone I met with last week. They watch our television show, and oddly enough, they asked their coworker, should they come in and talk with us as a group, and their coworker is actually one of my clients. So it seems like everywhere they turned, whether it was TV or their coworkers, because they actually knew two people, but I met with this couple. And they had about $2.5 million. About $1.5 million was still in their 401ks, and about $1 million was with another financial advisor here in town that was with a national name brand, well-recognized corporate company that, again, is nationwide. And I asked them in their first introductory meeting with me, let's call them Larry and Mary, because I can remember that name right now, right? So Larry and Mary, they were having this conversation with me in their first appointment here in the office. And I was getting to know them, getting to know what was going on in their situation. They're planning on retiring this July. But their other advisor that they'd been working with for a couple years now, 5+ years, they had no idea what they were really paying in fees. So actually, Mary had took it upon herself before our meeting, our first appointment here in the office, to call her previous advisor and ask what she was being charged in the way of fees. And her advisor took a long time to get to the answer, she said. And she said, finally, when they arrived at the answer, he said, well, around 1%. Now, through our retirement report process that we take people through here, I said, well, we'll find out if that's true, Mary. And we talked about some of their other concerns, and we talked about their income needs and where the income would come in retirement because they couldn't just live on their Social Security. And that second meeting that we had, which is our retirement report, which the report stands for Retirement Evaluation Process, Other Risks and Taxes, REPORT. And when we're doing this in-depth dive of people's current situation, because you have to know where you're at before you maybe want to go anywhere. Isn't that true? I mean, you don't just want to come in and say, well, you know, Danny says it a lot of times, I got gold watches over here and got gold chains over here. It's not like we're selling things. We are tailoring a plan to your circumstances and your situation. So that takes some time to get to know you. So after that first appointment where we get to know the person or the couple and find out what's going on in their situation, the second appointment's where we do the analysis. And when it came time for the fees part of the analysis, they weren't being charged 1%. Well, let me take that back. They were being charged 1% on their stocks, but the advisor had a variable annuity in there. And I've seen some good variable annuities, and I've seen everything in between, all the way up to bad variable annuities. This one wasn't the greatest. The fee here was 3.5%. So yes, they were being charged around 1% on their investments, but they had a variable annuity with a well-known insurance company that they were paying 3.5% on about $200,000. So they were paying $7,000 a year in fees on just this $200,000 account. Mary was upset. She goes, the advisor didn't tell us anything about that. Get me out of that. There's no way I need that. We continued the conversation. It was for an income rider that would pay her out about 6% over her lifetime, over her and Larry's lifetime. And this was just something that she didn't think was very suitable for her, very applicable to her, and she certainly wasn't happy with paying the 3.5% a year in fees. They were certainly not getting 3.5% in value for what they were paying on that $200,000 in their minds, and certainly in mine. But we had that conversation as a group because it's their money, right? We just help you figure out what you're being charged on that money. And after having the conversation and putting together a plan, their overall fee is like 0.5% on $2 million. But now they're not just getting investment advice, they're getting tax advice, tax planning, which is going to be very important as the tax code will probably change this summer. We're hearing that out of Washington, and whether it changes probably for the good, not for the bad in the most part, you need to make sure you're maximizing that good change. And how do you know you're doing that if you're not taking advantage of that tax planning before the end of the year rolls around? And that's what they were so excited about. But of course, Mary was very excited that she wasn't paying 3.5% anymore in that variable annuity. And guys, if you don't know what you're being charged, but you know that you're not getting tax advice, you know that you're not getting help with your estate plan, you know that you're not getting your health care, your Medicare advice as well, you're just getting just the plain old investment advice, but you don't know what you're being charged for that plain old investment advice, I can tell you, you're probably paying too much. But how do you know if you don't go through the process? And if you're worried or maybe even have questions or maybe even have some concerns, God forbid, anxiety over what you could be paying, reach out and schedule a 15-minute introductory call at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to that website at retirehour.com or, of course, marketadvisorygroup.com. Well, stay tuned. We'll be back with financial advisor Danny Goolsby out of Wichita, Kansas. 2/3 of investors are worried that they'll outlive their assets. We'll continue that conversation right after this. Stay tuned. So welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm your host, Matt Goolsby, and we've got Danny Goolsby here. You know, you remember that time we were on that trip and they thought we were brothers? I know you were flattered.
I was flattered, but you hadn't had makeup on yet.
I don't have makeup on today. So you're here to talk to us about the fact that, and I've seen this study, we've seen this studied several times. There's multiple studies out there. More than half, or 2/3 of investors are worried they'll outlive their assets. So basically, in layman's talk, they're afraid of running out of money in retirement.
Yeah, this is a study, as you referenced, we've seen this study in one form or another over the last dozen years or so. But this is a really most recent study out of March 2025, so just here real recently. And this comes from Global Atlantic's Retirement Outlook Survey, where they surveyed over 1,000 different retirees and pre-retirees to come up with some of these conclusions. And so, they were talking about how they had issues about income, where that income was going to come from, Social Security, safeguarding their wealth, things like that. And so let me stop there before we get into that study. And I know that we as Americans, and taxpayers, we like to see ourselves as individuals. We're not the same. Going down the road, we're all different. We all talk about we all have our own thumbprint to things, but so me and my sisters, for example, our Social Security numbers are one number off.
Oh.
So we can really mess with each other's Social Security number if we wanted to.
I never knew that about my aunt and you, or aunts and you.
But even though, we were in the same household, reared under the same roof, exposed to the same influences. My sisters, they're different than I am, and so we're all individuals. But here's how we're all alike, and that is with this study that reveals, it says that 2/3 of investors, they're worried they're going to outlive their assets. So let's dive into that a little bit. This study based on responses, as I said, from more than 1,000 individuals between the ages of 55 and 75, and they have assets between 250,000 to 2 million. So it was a wide range of people in there, which is good. But they found that 2/3 of investors are worried that their retirement income may not last their lifetime. And then among those respondees, 3 in 10 said they are extremely or very concerned. And so you start to dig into this, and we have these conversations in our office all the time with people, with prospective clients, and we do these reviews with clients, making sure that we're checking all the instruments and everything is running according to the plan. But I was dealing with someone who, for the first time yesterday, I think it was in our West office, and they were going through these very things. Like, I have this much money. I want to retire. I want to separate from my employer at the end of the year. But between my pension, because this person was fortunate to work for a company that had a pension, between my pension and what I've saved and my spending habits, will I have enough? So it seems to be a continual theme that, when you're in your 20s, 30s, 40s, you really don't give a lot of credence or a lot of thought towards this kind of thing. But as you start nearing those retirement years, the 50s and 60s, you start to really become almost obsessed with this kind of thought, because you want to make sure that when you separate, that you don't go back to work unless you want to.
Now, I take a little bit of offense to that because I'm in my early 40s and I think about this every day. But I know that's not the norm.
Well, you have a different kind of OCD, though.
Yes, you mean a CDO. But anyways, the fact is, I hear this too a lot in the conference room, and normally it comes out something like this: of, I'm just afraid we didn't save enough for retirement. And sometimes you got the guy that's saved $2,000 for retirement, and you've got the couple that saved $2 million. And sometimes people are like, yeah, 2 million. Yeah, that doesn't sound like someone saved enough for retirement. Yeah, right. No. I mean, it gets back to the income need. I mean, if you're spending $250,000 a year, $2 million is not enough probably saved for retirement.
It's not. And my mother, in one of her nice little idioms, she said growing up, she said, if you spend more than you make, it doesn't matter how much you have. So
wise words.
Yeah, she was a wise woman. So this study, delving into it a little bit deeper, though, so it talked about the desire for retirees and pre-retirees to have that stability in income, and we're shaping retirement strategies. The study found that nearly 9 out of 10 people in the survey said that they wanted a steady stream of income that would help them lead a much more peaceful retirement, and not necessarily living with their heart in their throats every time the stock market goes into a panic, or every time something happens in our financial media that ticks off a fragile economy. And are we going to be able to have our income this year or this month? Are we going to be able to do things fun because the stock market's down? And so these people that were being surveyed, they wanted to know, hey, where's our steady income going to come from? And so that pivots right towards a lot of this study. Also talked about Social Security, and how a lot of it is, as a lot of retirees and pre-retirees now are starting to say, how much scrutiny is it being under, and will there be a shortfall at some point? How long will it be able to sustain me in my retirement before it becomes a shortfall? I know that Social Security is kind of a hot potato in the finance or in the political world.
What do you mean? No, it going very well.
Right? Yeah. So it's don't change and it'll work just fine, right?
Well, there's a lot of things that are going to happen with Social Security. I talk about it a lot in my class, or even on the radio or TV. But I think there could be a chance for the next 4 years where they eliminate the tax on it. There's going to be a huge tax planning opportunity for our clients out there to do Roth conversions, especially if your Social Security is not being taxed. Or not taxable, put it that way. But then I think to shore up the program, because the program is estimated to run out of money at 2033, but if they do eliminate that tax, I believe it's 2031. But if that won't be in this next 4 years, is what I'm getting at. Well, then maybe the next president has to figure that out or fix it. And I think eventually, we've talked about it forever, they talk about a means test.
Isn't that unlike Congress to keep kicking the can down the road, though?
No. Yeah, they're going 2-year cycles. I mean, they're just looking to get elected every 2 years.
I think you're right. I think that the last time that Social Security had any kind of changes to it all was 1983. As well,
you remember they eliminated the spousal strategies back in 2015.
Sure,
they closed up some of those windows. But yes, major overhaul was when it was running out of money the first time.
Right.
When Reagan was president and Tip O'Neill was Speaker of the House.
Right.
But it was. I mean, I think it was within months of running out of money. If I'm recalling the whole history
I've slept
correctly.
since then, so.
Well, but then they introduced the taxation on it.
Yep.
Which the taxation while you're collecting Social Security helps go back in and fund Social Security to the tune around $50 billion a year if you don't count the Medicare premiums, $80 billion a year if you count the Medicare premiums. I've seen some studies that say that. But the payroll tax the payroll tax funds Social Security to the tune of about $1 trillion plus a year. So, that you could look at that and say, well, that's a little out of balance, but the whole intent of Social Security was to provide that retirement safety net, not maybe provide for your whole retirement.
That's right. That's right, from cradle to grave. So again, it is a concern that people are continuing to become more and more obsessed about because the reality is hitting them.
And as this is probably going to see some changes potentially to the taxation, and eventually they're going to have to do something to it because, again, it's projected to run a shortfall here within the next 7 or 8 years, depends on the circumstances. If you're concerned, or maybe if you don't even know what right Social Security options are for you, reach out and give us a call and have that 15-minute introductory call with us, 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to the website at retirehour.com. Well, stay tuned. We'll be right back with Larry Clefcorn, an advisor with Market Advisory Group Wichita, bringing up a listener question from Paul. Now that the final tariff-free ships are from China, how do we maybe prepare for this tariff to take effect? Stay tuned. You won't want to miss this. We'll be right back. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And you can go to our website at retirehour.com and submit your listener question. But we've got a listener question this week from Paul with the last initial N. And Paul, appreciate this question. Hopefully Paul provided his mailing address, because if you provide your mailing address, we send you a little thank you for submitting that question on the show, whether it's a coffee mug, an umbrella, a portable battery charger. There's a lot of swag out there to get as, just a token of our appreciation for listening to the show and submitting a question. You can do that at retirehour.com. So this question this week, now that the final tariff-free ships are from China, are on the way, how do we prepare before Trump's tariffs take effect? And that's from Paul. And Paul, thank you for that question again. And, this is, the markets, the indexes have kind of bounced back a little bit. That's not down quite the almost 20% it was at one point in time. And, maybe things are looking a little rosier, but we really have yet to see any implications, any economic direct implications from these tariffs going on. And what says Larry Clefcorn?
Well, and you're very right about describing what we've seen the last few weeks, which I think we would both agree reflect on the waivers that he put out, waiving this and waiving that tariff. And these are delays. These aren't removing them forever. They're just delays. And so if that helped the market go up and it helped people for the time being, it helped their stress level come down, that only gives me an indication of how it will ramp back up. While stress goes up, the market probably coming back down is very much a possibility. And if I could throw something tongue-in-cheek out here, I hope you're stocked up on your toilet paper.
Oh, yeah. I mean, that might be like...
Remember that one?
Yeah. So you're referring back to COVID when there was a run on toilet paper for whatever, I can't remember the reason that started all that panic, but people went and bought it in droves.
And the shelves were empty. And
there's been some CEOs out there that have gone to the White House and said, hey, if this doesn't get let up, prepare for empty shelves. And you got to think about the fact that will Trump flinch and roll those tariffs back? Or again, is this trying to promote the reindustrialization of our nation so that we can make things here? And I get I understand, I can see his rationale, but there's going to be a lot of ripple effects. And as he said in his address to Congress, little disturbance.
That's right.
That's my best Trump voice. I can't do that really well today. But these disturbances, if you're getting ready to retire and you see these 20% swings or empty shelves that can impact, that could have a real impact on someone's retirement plan.
It sure can. And I've talked recently about people who get concerned, they called their advisors and said, stop that money that you're sending to me, stop the supplemental income. I had my first person express that concern just yesterday. And it was in a review. And I said, look at your piece of paper in front of you again. And they stopped and they did. And they said, oh, we're actually up.
How about that?
And I said, it all comes down to how you're invested and how we continue to monitor it.
Well, there's different strategies. There's different buckets out there that we help people diversify with. And I had a gentleman by the name of Jeff. He's a client of mine, been a client for over a year now. Jeff says, you know what, if I can just make 8, 9, 10% when the market's doing good, and if I can hold on to as much as I have when the market's not doing good, that's my goal for retirement.
Yeah.
They want to smooth out those volatile swings that they have because they realize they're not going to be working anymore. Jeff's going to retire here in a couple of years. And that's all the money they're going to have to their name.
Yes.
They're not going to be making any more of it, adding any more into their 401k, adding any more to their savings. They're not going to be on the distribution, kind of the downward slope. And Jeff's concern is if you have these 20% swings, or if you have these big pullbacks in the market that could come from then the chaos over the next 3 or 4 years as these tariffs play out, they're going to have an impact, guys. They just are.
Yeah.
You can already see it.
Now, a couple of things we should mention is GDP. So we've got the first leg that we may have a possible recession set up. Normally it's 2 quarters of negative GDP, and if you ask some, it needs to be accompanied by this or that, you know.
But the setup's already there, right?
Yes, the setup's there. Also, there have been plenty of these corporate leaders who, by the way, they were telling people that they were sensing that we may have been in starting one or be in one already because it's a lagging indicator. We get the information afterwards.
Right.
But there's been some more talk I've heard this week of stagflation.
And stagflation's where inflation keeps going, but economic output comes down, and your purchasing power gets eroded quickly.
Yeah.
And if you're thinking out there to yourself, I'm concerned that I don't have a plan for what's going on, or maybe you're within 4 or 5 years of retirement, or maybe you've just retired. If you don't have a plan, if you don't have a strategy to help weather the potential volatility that could continue that we've already seen, reach out and schedule a 15-minute introductory call with us at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to our website at retirehour.com or marketadvisorygroup.com. We'll stay tuned right after this break. We'll be talking with Corey Hebert of Market Medicare Advisors of if you're drawing Social Security, what impact does that have on your Medicare premiums? Stay tuned. We'll be right back with more right after this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And there's a lot of changes happening right now, and we've got Corey Hebert here. Now, you have a story to share with us. Let me get this straight. This is someone who it's husband and wife, and this husband and wife, let's call them Bob and Sally. Excuse me, Bob and Sally. Excuse me. Bob and Sally, Bob's continuing to work. Sally's not working anymore. She's kind of retired already. She's drawing her Social Security, but she's on her husband's health insurance. So this is what you're talking about if you're drawing Social Security and you turn 65, there's some things that are going to automatically happen here to Sally.
Yeah, so this is Sally is one of those lucky individuals who anymore does get to retire not only before full retirement age, retiring all the way as early 62 or 63, and in order to retire, starts to draw on her Social Security benefits.
So she's collecting Social Security, maybe started as early as age 62 here, and maybe staying at home, and maybe she's again retired early. Bob's continuing to work, so he's not his full retirement age. He shouldn't start his Social Security because he's working. But the thing you're going to talk to us about, because you deal with the healthcare, this is probably going to have to do with something about their health insurance, I'm guessing.
Yeah, absolutely. So, on the other hand, Bob, also in a very, very lucky role, he's with an employer that pays a good portion not only of his health insurance, but also his spouse's health insurance, and keeps her portion of that premium low on a monthly basis. So, Bob and Sally are operating with the intention that they're going to continue on his insurance as long as they possibly can, right up until Bob is ready to retire. Lo and behold, about 4 months before Sally was getting ready to turn 65, she got a letter in the mail from the Social Security Department. And inside that packet was her Medicare card.
Parts A and B?
Part A and Part B.
Well, I'm not the Medicare guy, but I do know enough to know that if she's covered under her spouse's insurance, she doesn't need the Part B, right?
You're exactly right, Matt. And this is I chuckle a little bit at this scenario because we run into people all the time where one of their most burning questions is, help, I don't know where to go to file for Medicare, or how do I get enrolled, or what does that process look like? And here we have Sally, who knew that she didn't want Medicare, that she was going to continue on Bob's plan for quite a while longer, and she ends up with her Medicare card. Didn't request it, didn't ask for it, and never filed for those benefits.
Let me make sure I'm tracking here, and again for our audience, they're tracking too. So Sally was receiving her Social Security. She was on her husband's insurance. As she turned 65, she was auto-enrolled in Medicare's Part A and B, and that wouldn't be a big deal except for the Part B premium's $185, and all of a sudden she's shorted $185 a month on her Social Security check, which I'm sure that's not a pleasant surprise.
Yeah, and that's for coverage that she doesn't necessarily need. Whenever we talk about Medicare can be great coverage, an employer plan can be great coverage. Those two things don't always mix in perfect harmony like they should. And the key to what you just said there, Matt, was the fact that Sally was drawing Social Security before the age of 65 is what got her automatically enrolled into Medicare Part A and Part B. She didn't request it. She didn't want it. They just assumed because you're drawing Social Security, you're going to need Medicare at 65, so here is your Medicare card.
Now let's go what if. So let's say Bob is 64 and he's going to work for 3 more years. What if Sally doesn't even know this is going on, and she just has that Part B premium coming out every month in the background there? But when she goes to the doctor is not billing her Medicare, because just because you have Medicare and private insurance or group plan doesn't mean you're going to get to use both of them. Normally, the group insurance is always going to cover those things correctly. I mean, the group insurance is going to take priority. Medicare is not going to cover much, if anything.
So Medicare may take priority. It may step up and pay. But what you're looking at a square peg into the circle hole. They don't quite fit. There are a lot of gaps that are going to be left around the edge. And even though you have 2 primary forms of insurance, there are going to be more out-of-pocket possibilities compared to a primary and a secondary insurance, which may be less expensive.
And so now I know that this is a whole nother story. I know that you've ran across people that were having that Part B premium come out, but then we're still covered by a group insurance plan, and you actually have been able to get a couple of those refunded, right? I mean, I know that's not the case for everybody, but this is something that people need to pay attention to, because there might be that chance where you can't get it refunded, and you don't want to have that almost $200 a month expense out there for nothing.
Yeah, I would say I would never bank on that refund being something. You can't really throw your hands up with Social Security and give them a whoopsie. But what is important, and I would like to get this message out there, whenever Social Security is mailing you information about Medicare, it does come in a pretty solid white envelope with not a whole lot of identifying markers on the outside of it,
But
and for good
I was
reason.
going to say that's for security, right?
But it does make it important that as you approach the age of 65 or as you start to file for Medicare, we're conscious of that and we aren't just throwing away junk mail as it comes in. But the best thing to do and the best course of action here is if you are one of those people that are automatically enrolled into Medicare Part B, they actually do make it fairly simple to get disenrolled. That letter comes with a return envelope. It is as easy as signing the back of the Medicare card and sending it back to Social Security. Now, that can get you disenrolled from Medicare Part B, but it can't get you disenrolled from Medicare Part A.
But there is no monthly out-of-pocket expense if you have your 40 quarters or you paid enough into Medicare. There's no monthly expense on that Part A.
Yeah, that's absolutely correct. Part A, it's we're not going to see a whole lot of benefit, but you're also not going to see a whole lot of downside to having it.
And so, guys, if you're thinking out there, man, this sounds like us. We're, I'm getting ready to turn 65, and my spouse is still covering me under the group plan. Or if you just have general questions about Medicare in general, reach out and schedule a 15-minute introductory call with us at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to the website at retirehour.com. Well, stay tuned. Right after this break, we'll be back with Doug Chowder with Eidelman Law Firm talking about make sure all your beneficiaries are up to date and the possibility of what can happen next if they're not. Stay tuned. We'll be right back with more. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. We've got a new tax advisor in Kansas City, and her name's Ashley, but she'll be on sometime, I'm sure. But Doug Schauder here and I were just talking at the break. This actually kind of ties into something that we've all been collectively on this email string going back and forth about. Well, then this, well, then that. Oh, I didn't know that, and this, then that. And it's interesting how when you get all the different professionals involved, the estate planning attorney, the tax advisor, and the financial advisor, and you get them all having these conversations, so much comes out, and then normally you need more answers, there's more questions to be answered, and that's the benefit of, again, working around the same table as a whole retirement team. I'm often reminded of my 6th grade science teacher at Goddard High School, or at Goddard Middle School, Mr. Lester, and he'd always say when NASA gets one question answered, it normally generates 2 or 3 more. And this is kind of that example of you can start going down the rabbit hole here and not really know. There can be a lot of variables, I guess, to put it simply. So this is something where if people pass away and they don't have their beneficiaries up to date, it may have to go through probate, and that's not a pleasant experience for anyone.
No, and so what happens with a lot of folks is they've got an insurance policy, or they've got a retirement account or something like that, which has an ability to have a beneficiary named on it, and a person typically when they start out the policy or start out their plan, they put somebody down, they don't think about it. Or in this case, we had an individual who had his retirement account and didn't have kids or a spouse, so didn't put anybody down, and it wound up falling into their estate, so it has to be probated out. So that this has created a situation now, particularly with the retirement plan, where there's a whole bunch of unintended consequences that are going to cost the ultimate beneficiaries of this. Probably, this was a pretty large retirement account, so they're probably going to be out $200,000 of taxes more than they would have been paying anyway. But all because they didn't put the beneficiary in. But
and that has to do with the retirement accounts, right? I mean, you can't stretch those taxes out. But then further, I mean, the probate expense. You guys talk about the probate expense is anywhere from 3 to 6% of whatever the asset is that you have to probate.
Yeah, and in this case, it might be based on the attorney's fees, but still are going to be thousands and thousands, or probably tens of thousands of dollars of attorney fees that would not have to be paid. And in some states, it is a percentage basis, so it could be upwards of $100,000 potentially of of attorney fees for that. We see the situation also a lot of times with a former spouse. A person gets divorced and they don't think about changing that policy out, and so you've got a unintended consequence of, probably you didn't want your ex-spouse to get the account or to get the proceeds of the account or the insurance. In Kansas, they would be regardless of the fact that they're not the spouse anymore, they're still the beneficiary. In Missouri, it's by law, it is not, they're not to get it, but the insurance company oftentimes doesn't know that. And now you've got litigation about the fact that the person didn't, wasn't supposed to get that proceeds. And now a new spouse or children or somebody like that may be suing a former spouse. In some cases, I've seen a person sue their parent over proceeds. It's not
Isn't that
not
a
a pretty
good family
situation.
dynamic? Well, so to give some more background here, Greg, he's the beneficiary of his uncle's estate per his uncle's will. So you'd think, oh, well, don't worry. I don't need to worry about the beneficiaries because I have a will. But a will is written instructions to the probate court on how to divvy up your stuff.
Sure. Yeah, and so that it has to go through the probate process. If this person had been named on the retirement account, then they would have a different, they would automatically get it, not have to go through the process of probate, but also wouldn't have the cost and the time, and now a shortened window on how quickly they have to withdraw these funds.
You mentioned that shortened window. That was something. Do you mind? I don't want to throw you on the bus. Do you mind if I?
Yeah, go ahead.
You weren't even aware of that rule, right? And that's okay.
Yeah.
That's why we work together as this team. So what you're talking about is if there's no named beneficiary on the retirement account, the Secure Act says if the retirement account, the IRA, 401k has to be probated, the Secure Act says you have 5 years to take all that money out, not the 10 when you have that named beneficiary. And you were surprised by that. And it's again, that was a tax thing that was coming up. And the tax team was talking with the estate planning team. And it's great that we can work together on all these things, because as the laws change, and we know some laws will be changing soon here with Washington, this is a complicated thing to navigate on your own, let alone it's a complicated issue to navigate if you're the individual that's having to go out and talk with the estate planning attorney, take your notes, and then now go over to your tax person and take some notes, and now go back over to the financial advisor and take some notes. It places a lot of burden on that person that's having to relay all the information between the people, right?
Sure, yeah.
And so that mention of that, you were exactly right. Probably the worst thing is on this $1.7 million 401k. This is not a small 401k, right? I mean, it's pretty big.
Yeah, it's a large one.
And again, the 3 to 6% on the probate costs, that's going to eat $30,000 to $60,000, if not more. And then you have the tax consequences on the not the 10-year, but the 5-year. And now they have to have all that $1.7 million out and pay the taxes on. That's going to be a big tax hit.
Well, and this is the other issue is that it's taxed because the estate is the beneficiary. It is taxed at the estate income tax rate, not at the ultimate beneficiary's income tax rate. So it's a lot higher of a tax rate, or a much more compressed tax rate, so that it's probably going to be coming out at a significantly higher taxable rate that they're going to ultimately be paying on that.
Now, this is something you and Jonathan, one of the advisors in Kansas City, you guys are working on this case right now with Ashley, your tax advisor up there. And it'll be interesting. I'd like for you guys to come back and kind of tally up what this total cost his estate, because I've put some pen and paper to it, and it's going to be well over $200,000.
Yeah, it's going to be expensive.
And I think that is the lesson to take home here, because I think a lot of people will look at estate planning and go, well, that's expensive. Not having a plan, or not having a plan correctly implemented, is more expensive than any kind of estate planning you guys do.
Sure, yeah. I don't think the uncle was wanting to, take a couple of $100,000 potentially that could have gone to his nephew and say, you know what, I really like Uncle Sam even more than my nephew. Let me give it to him.
And guys, if you're thinking to yourself out there, I don't want to be the person that has to relay all these technical details between the professionals, reach out and give us a 15-minute call today at 833-MAG-REPORT. Or that phone number again is 833, the letters MAG for Market Advisory Group Report. Or hop on over to the website at retirehour.com or marketadvisorygroup.com. Well, stay tuned. We'll be rounding out the show with Susan from Market Tax Services, talking about this other little thing that was going on. Was it having an impact on should they start their Social Security? Stay tuned. You won't want to miss this. We'll be right back. Welcome back into Retire Hour, the weekly show that helps you stay up to date on all things retirement. And we've got Susan in here with Market Tax Services. And was this a tax client or was this an advisory client?
It was initially an advisory client.
Well, now they're an everything client, I'm sure,
Yes.
right? Yeah. So this is Tom and Sue. They received an inheritance back in 2006, so almost 20 years ago. And it was a farmland. And they had this question of, well, if they decide to sell it, if they're not really, because since they haven't really been doing much with it, they're thinking about selling it. And I'm kudos to Tom and Sue for getting tax advice before they do something, because a lot of people don't do that. So they're talking with Jonathan, I'm sure, is their advisor, and they bring in you, the tax advisor. If they decide to sell this family inherited farmland that they've held for well over 15, 16, 17 years, there could be some gains here, right? And it could be taxable. But their question was, did it make sense to start their Social Security? So I don't even know if that's a question a regular advisor could ask because of all the different components that are going here and here. But tell us some more. What are some of the other details I'm leaving out here?
Well, he had so Tom had just retired, and he was starting his pensions and getting all these different, IRA distributions and whatnot. So he wasn't sure how all the income was going to affect the sale and the taxability of that sale. And like I had mentioned to Tom, that when you inherit property, your cost basis is the fair market value at the date of death. So back in 2006, that fair market value was $60,000.
Ooh.
Well, now you're selling it in 2025 for $300,000. That's a $240,000 gain on top of ordinary income tax on your other income.
So he's held on to it for some years now, but he's going to owe taxes on any of the growth above and beyond what it was valued at the date he received it.
Correct.
So that's his cost basis. That's an industry term we use. So that's his entry point. So now he's going to sell it for $300,000. He's going to have $240,000. Now, is that typically that's taxed at capital gains rates, right?
Yes, which is anywhere, from 0, 15, and 20% based off of your AGI.
Normally, knock on wood, normally a lower tax percentage than traditional income taxes. It's meant to foster and promote investment out there. But there's going to have other implications. I don't know that he's going to get a big hit on his Social Security. I mean, it will cause him to pay, or it will cause his Social Security to be 85% counted as taxable income.
Correct.
Right, sure. Mm-hmm. But it could cost him more for his Medicare premiums.
Exactly. And that's where we start talking about, IRMA and going over that IRMA cliff. And that was something that, he was very concerned about, because when you are retired, a lot of times you're living off of a fixed income, so you may not have the funds or whatnot to pay for those fees.
Well, and the bad thing with IRMA is it hits you a couple years after you've done it. So
right.
He'll sell this land, he'll trigger capital gains. Will he hit the net investment income tax? He's close to it, isn't he? Mm-hmm. And maybe part of it, and then IRMA, and then the taxation of Social Security. There could be a lot of hidden taxes here if he's not paying attention or not working with someone that can help him navigate those issues. But the IRMA thing, that's kind of the kick in the gut, because you might sell this land 1 year,
right?
But in a year or two, then Social Security will come knocking with the envelope, and normally those letters go out October, November, and you get that envelope, and you're like, what?
Right.
They're going to withhold $80 or $160 or $200, whatever the amount is. I mean, they're going to hold extra money out of my Social Security payment starting in January. Why?
Right.
And I'll argue all the time in my classes, or I'll pose the question, I won't argue. Is IRMA, which stands for Income Related Monthly Adjustment Amount, is that your Medicare guy's responsibility to tell you about that? Is it your financial advisor's responsibility to keep you under that limit? Or is it your tax guy's responsibility to make sure you're not hitting that? And my argument is it's all three of theirs. Exactly. But if they're not talking to each other, whose responsibility is, it's the retiree, it's the individual. And we find that people, even if they're aware of it, but most people are not aware of it. And how do you avoid something that you're not aware of?
Right. And that goes back to, you don't know what you don't know, and you need to seek out the professional help.
So you guys helped them walk through this situation. I'm sure it gave them better clarity to make a decision in their circumstances. And that's what everyone wants, right? And if you don't have the clarity in your situation where you get tax advice before you start that pension, before you take that IRA withdrawal, before you sell that piece of property, before you receive that inheritance, I can go on and on and on. But if you don't get tax advice before all these things hit you, reach out and schedule a 15-minute introductory call with us at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to retirehour.com and you can book that there, or even submit a question like we had from, was it Paul earlier? I believe it was Paul. Yeah, Paul. Love that. And if you submit your address there, we'll send you a little thank you in the mail, whether it's an umbrella, a coffee mug, a thermos. We've got a lot of little freebies there. Just a little thank you for submitting that question and listening to the show. Well, that's all the time we have this week. We thank you for tuning in. We also want to let you know about our other shows. Eye on Retirement. They all got retire in it, right? And then Health and Retirement. We've got all these other shows. You can go check them out at our website at marketadvisorgroup.com. We'll see you next week here on Retire Hour.
Unless otherwise indicated, all client names have been changed to protect their identities. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Eidelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. All rights reserved.